All right. Hello, everybody. We got a few more people filing in. I see people joining, but we'll go ahead and get started. Make sure we stay on time. I want to thank everybody for joining us today. My name is Eric Hahn. I'm a managing director here at Ennis Capital, and I'm so excited to have you joining us today for another one of our Meet the Manager webinars. And we have an incredible guest for you. Now, before we get started, just a simple reminder that everything discussed today, no solicitation to buy or sell any securities. Everything is for informational purposes only. And now, without any further ado, I'd like to introduce everybody to Todd Peters, the chairman of Ennis Capital's investment committee. Todd?
Thank you, Eric. And again, thanks to each of you for joining us for our third Meet the Manager. We hope you find this both interesting and informative, a chance to learn from and about our manager partners. And as Eric said, we are extraordinarily excited to have Dan Lysick, Senior Portfolio Manager of Miller Value Partners, for today's conversation. Dan has been a trusted partner in the Alpha Ring since May of 2018. Now, we are very grateful for a business development colleague of mine for recommending that Dan reach out to us in late 2011, and we are most grateful that he did. We had our initial meeting with Dan on January the 9th of 2012. And it was very clear from that initial meeting of Dan's passion, enthusiasm, and knowledge for investing. And we knew that this was somebody we wanted to get to know better. And so between 2012 and 2018, we conducted an additional 25 interviews with Dan, including in-person meetings in New York City and at his office in Baltimore, Maryland. And after each meeting, we became more and more convinced not only of his investment expertise, but of the quality of the individual that he is. So in 2018, when the investment committee decided to restructure the Alpha Ring, we knew that we wanted Dan to be a part of it, and thankfully, Dan agreed. Now, Dan operates within a segment of our Alpha Ring called the too cheap to ignore bucket. And essentially what that means is the investing public has become disinterested or has decided to ignore a group of companies. And when that happens, you have a disconnect between the operating value of the company and its publicly traded stock price. And so it gives an opportunity for somebody of Dan's expertise to take advantage of that. Dan focuses on our smaller companies in the United States primarily. Now, before I bring Dan in, I'll go through a few of his accomplishments and his career path so you can get an understanding of what we saw and continue to see in Dan today. Dan is a 1997 graduate of the Columbia Business School's Value Investing program. It is one of the industry's and nation's most prestigious programs in the investing space. He has been a 1998 Chartered Financial Analyst designation charter holder, or since 1998, I should say, which is a rigorous 3-year program just to be enabled to have the charter. His investing career began in 1997 at Brown Investment Advisory, where he stayed until 2005. The last 5 years, he was portfolio manager for the value strategy, which we will discuss in more detail in a moment. He helped take that strategy from a $100,000 firm investment to a $1 billion pool of capital in a mutual fund structure. In 2005, he was recruited to PNC Capital to be senior vice president and head of fundamental equity investing, where he was overseeing a $1 billion pool of capital at PNC. In 2009, at the recommendation of Bruce Greenwald, who was the director of Columbia Business School's value investing program, Dan finally had the chance to make the leap of starting his own firm. And so he formed Pratt Capital in 2009, which he operated independently until combining forces with Miller Value Partners in 2016. And we'll discuss more about that collaboration later on in the interview. And so with that, Dan, thank you so much for joining us today.
Hi, Todd. Thank you for having me. Appreciate it.
It's great to have you. It's great to have you. So let's jump right in. And one of the things, Dan, that we state that we look for in the managers that we partner with are the ability to create their own strategy, but also to have a differentiated view. And I think there is no better way to start the differentiated view and own strategy discussion as you at Brown Advisory, which, as we all remember, in 97 to 2000 was the go-go years of the original internet. And Brown was very much into the telecom and media and telecommunications space. And you coming out on your own stating, you know what, I think I see an opportunity to do something where we should focus on price first, not just growth. And I think that's an interesting place for us to learn about your start in the industry, and particularly in your segment of the investing space. So if you wouldn't mind, expand on that for us.
Sure, love to do that. So it was interesting. You go back to the 2000 time period, you had a market that obviously was becoming very concentrated. As you kind of alluded to, telecom media valuations were expanding. The overall S&P 500 was approaching a 30 P multiple, a 3% earnings yield. And with the bond market at that point, that has 6% yield. And so opposite today, bond market was 2x more attractive than the equity market. And so we had clients that were looking at equity market that was getting more expensive and were concerned in general about how do we go about investing there. And we saw a significant amount of dislocations, companies that were not being well followed that provide very attractive low valuation opportunities. And so in my prior experience of being at Columbia, we looked across the marketplace and said we could put together a pretty diversified portfolio, about 40 holdings, all up and down the market cap spectrum. And these holdings, we thought when we looked at the valuation multiples of being a double-digit earnings yield was 3x the overall market. And so we got very excited about what that portfolio could potentially do, especially when it was 3 times as attractive versus the overall market in general. And so if I was to take a second, maybe fast forward to today, there's a lot of similarities back to when we started that initial kind of time period, because you have a market that's gotten a little more concentrated in totality, with the larger market caps in general that have been kind of pushing up the valuation multiples. But different than that, it's been driven by low inflation and lower interest rates. But there's a tremendous amount of dislocation in the market today, similar than there was back in the 2000 time period. And so when I look at our deep value strategy today, it's a north of a 30% earnings yield and normalized free cash flow yield. It makes us as excited today as it was back in 2000 when we first started the strategy.
Interesting. Now, if we continue on the starting of the strategy in 2000, did the leadership at Brown kind of see what you saw, or did it take a lot of convincing for them to give you a chance to start the strategy?
So it took a while, and that's why we started with the $100,000 of firm capital. And so it was literally in the June time period in which this started, and the market started to kind of break somewhat in recognizing some of these lower valuation securities around March of that year. And so it was interesting. When we started it, we initially internally called it the non-tech telecom and media strategy.
Right.
And then it even evolved over time to we called it the green banana portfolio, where you had these, over time, as the market recognized, you would have something the portfolio continue to be recognized and drive performance and ripen. And so it was an initial starting point that we started out that we had to do a little bit of convincing. And as the performance continued to improve, and we saw a lot of the companies that we owned that were so much more attractive than their peers within their sectors and the overall market, and that valuation gap starting to narrow. I think the confidence got even greater over time.
Excellent. Sure. Now, the initial strategy that you formed there was a lot of that driven from your time at Columbia Business School and the learnings that you had there. What kind of formed the underpinning, for you on that process?
So a lot of the initial screens that we put in place came out of work that was done by Fama and French and the folks at LSV, in which we would try to help us triangulate and look for dislocations in the market. And a common thread of a low valuation universe, studies that have been done historically and shown outperformance over a long time period. And so we developed these in a way to almost allow us as a value investor, your risk is being early. And so finding things that were dislocated, most likely in a big discount to the peer group, allowed us the comfort and the flexibility, the margin of safety to dig deeper, understand the business models and the opportunity for potentially where an investment could actually do quite well over a long time period.
Excellent, excellent. And I know we'll discuss kind of the evolution here in a little bit, but I know like you've continued to build kind of brick by brick on that initial founding. Now, one of the things that we do like to see and we really focus our attention on are people that are not only investment professionals, but they know what it's like to run a business themselves. And you made that leap in 2009 with the forming of Pratt. Could you give us kind of what was the catalyst for that? Why did you pick, then, and what was kind of that confidence in you that you said, you know what, this is the right time for me to step out on my own and form Pratt?
Yeah. So as you know, when you go back to coming out of the Great Recession of 2008, 2009, you had tremendous dislocations that were in the market. So a lot of companies who had revenues that had been under pressure for the prior couple of years, they were down in market price 50% plus, and their profitability for a lot of those companies were near historical troughs. And so when we step back and look at dislocations of price and value, to take a universe in which you're going to look at, the screens in which I was following were, I've never seen how many companies were actually coming through those.
Right.
And so we had clients that were with me at Brown that had recognized the same thing and said, hey, this is a very interesting time. And if I was to set up and go down the path of doing my own firm, focus just on doing the value strategy, they had interest in doing that because they saw a tremendous opportunity, knew the investment approach. You could actually go out and capture and be successful at doing that. And so that was the early part genesis of trying to do that. And again, having Bruce Greenwald's input on timing and when it made sense to actually go look at that. What I didn't realize fully, and I kind of came to me after a couple of years of doing it, is that what I tend to notice is that when you come out of dislocations like a recession, the reason the returns potential for value investing and specifically taking advantage of unloved companies is so great is that a security can actually get revalued multiple ways. And so you have the return, the profitability. So the market will a lot of times re-rate companies based upon that trough level valuation, assuming it's more permanent than potentially temporary. And so as the companies start recovering and move toward normalized profitability, you get a re-rating of the valuation that happens that also expands valuation and drives performance. And so that was a learning that came out. We saw our small and mid cap holdings within the portfolio do extremely well in the first couple of years. And like, dialed forward to kind of 2012 when we first started meeting, it made me interested in looking at a more concentrated approach for the strategy.
Right.
And so we initially started with 40 holdings, and similar to what I had done going back into the years of Brown. And when I saw how the performance and still within the portfolio, the small and mid cap holdings were still very attractive, becoming a larger portion of the weighting, it was just the next evolution step for me to go down the path of looking at concentration. And around that same time, also speaking with you, I was actually started meeting with Bill Miller and talking about what I was doing at Pratt, being that we're both in Baltimore. And he had a great interest in the concentrated strategy and actually became one of my first clients.
Excellent.
Yeah. So that was
I think,
go ahead.
I was going to say, for most people probably know Bill Miller, but for those that may not, could you just give a little bit about Bill Miller so that people can understand his importance in the industry?
So again, going back, I think he's one of the few, I think he's the only person who's outperformed the market for consecutive years as long as he did throughout the 80s and 90s time period. So incredible value investor, has incorporated free cash flow in his analysis to kind of find mispriced securities and whether the value or growth, but using free cash flow as the metric that allows him to kind of find these dislocations, and has had incredible success in his career, outperforming the market over a long time period. And so it was a great to kind of share with him when I first kind of met. We were sharing ideas of opportunities that we saw in the marketplace, and even his past experiences going back earlier in his career to kind of connect the dots and how the market had evolved and how his approach had evolved over time. So.
And when again did he become kind of one of your early concentrated portfolio?
Yeah, so it was in the later 2013 in that time period. And so I met with him periodically, probably a couple times a year, every year going forward. And so we had great dialogue. And so you can see how that the portfolio was kind of shaping up and level of concentration. And I gained a greater understanding. At that point in time, he was with Legg Mason, and he was looking to go out and actually become fully independent. And to me, having grown up at Brown, which was an independent firm, Pratt Capital, which is an independent firm, there was a great opportunity for me to partner with him, which actually led to me joining Nora Value in 2016. So as he and his team were separating, they had in place everything from a back office that supported his business for 10 plus years. So I would say a gold standard from an operations perspective, trading desk, compliance, operations. And so it allowed me, from somebody who was sitting in Pratt Capital with multiple hats, I could take a lot of those hats off, stick them in the closet,
Right.
and I could really hone in on the investment approach of the strategy. And so that was exciting in joining the firm. And the other aspects of the firm too that really was appealing. And I got to know Bill, and one was sharing the information across the investment team. There's a knowledge base. And we also have internally a strategy which actually invests across the capital structure. And so as a value investor who's looking strictly at the equity, you can get clues as to the risk and opportunity
Right.
by looking at the debt. And so if the debt's not signaling as much risk based on how the debt's priced, it gives you even greater confidence if the market's overreacting on the equity to actually take advantage of those.
Oh,
And
that's
so-
fantastic.
So that's been a great learning for me. And then I've also helped kind of use Bill's view on and focus on free cash flow into the investment approach and expanded upon a normalized free cash flow and normalized earnings yield for each one of the companies in which I own. So that's been incredibly helpful because it allows me to see how you can unlock value through capital allocation of the companies. And then greater access to management. So it was easier at Pratt to focus and get access to management to understand the businesses when they're small and medium sized. And so making the leap over to Nora Value, even greater access, allowed me to get even deeper knowledge of the companies. So
And
it's
the
great.
one thing that I've noticed too, certainly, and since we've formalized our working relationship, in that Bill also really appreciates the wanting to be just private again, wanting to be focused,
Right.
wanting to, not getting back into, some of the things that he was very successful with at Legg Mason, but just taking it to a different level. And you guys really had a similar perspective on that as well.
Yeah, and again, my feeling is that when you're independent and you have a lot of your personal capital, as every of the senior folks do here in the investment strategies they run, it's much easier to be fully aligned with clients and focus on the investments. And hopefully, if you're doing the right thing on squaring up more of your time and doing that, it's different than most of Wall Street. And it's a joke that we always have. It's interesting how a lot of great value investors are sometimes not located in New York. So being away from what's happening on the day to day, we're more focused on looking for opportunities and looking out 5 years plus on the companies and what that could actually mean. And in the evolution also of the strategy, when I joined here 3 years ago, I took the strategy to even more concentrated level. So today it's 10 to 20 holdings, and I've done that through becoming even greater comfort with the companies in which I own, and becoming, we can talk a little bit on how different traits of the strategy and investment philosophy has changed over time.
I think that's a great way to start, because as when we first met, yes, you were kind of still that 40 stock or 40 company kind of, and then we've seen you over time narrow it. And it's not just because you've decided to narrow just the number on its own. You've kind of gotten more involved with, management discussions, trying to be helpful, doing a lot more things to allow you to become more comfortable. So I think it would be great to understand kind of a little bit more of that timeline, how you started and now you are where you are today.
So the one part, probably the biggest influential and change for me, was recognizing a company owns the business model and they own the assets. And when you're dealing with security prices that are down more than 50% from their recent highs, the market tends to be really focused on the business model. and what may be potentially affecting near-term profitability and weighing it that makes the market concerned about the level of profitability. And it gets to the point where it may start to disregard a very attractive asset base the company actually owns. And so over the years, what I recognize is that understanding the assets gives you, one, a margin of safety for your initial investment and protection, because obviously that's the cornerstone of making sure you have a good return set, but also protection of capital that you're investing. But in understanding that asset base, there's also ways in which potentially you can monetize non-core assets and start to unlock value for equity holders. And when you get a greater sense of how the asset base is and the extensiveness, it allows you to start asking questions back towards the business model on what can be done to unlock and basically improve the operations over time. And so your comment that you highlighted on conversations with management, that's been the evolution of how I've gone from where we were just focusing on screens and lower valuation securities at Brown to where I am today, and which is an ongoing dialogue. We share with management our past experiences from how other management teams have allocated capital or made decisions to improve the business model in some of these companies. That dialogue is great because the management teams will come back to us and all of a sudden we'll look at what we're doing and it'll give us a deeper understanding of the business. And so the names of the holdings, as I've gotten more confident to take the holding size from 20, from 40 down to 20 to 10 to 20 today. And so that's been kind of a great evolution. And then the last thing I would just throw out is coming out of 08, 09, recognizing how compressed valuation and companies at a trough can deliver up, substantially higher returns. Companies that are going through transformations are also very similar to companies that are coming and the market coming out of a recession. And so a company going through a transformation, which may take 5 years, in most of the investment universe has less interest, there's less coverage following that. You can get a similar return set over a 5-year time period if you understand how the business could evolve and how the valuation could change. And so that's been another kind of natural evolution.
That's one of the things that we were most excited about when we began our conversations about you joining, the NS Capital Alpha Ring. So I have to ask you, had moved to Miller Value Partners, a much bigger firm. You certainly, we are grateful to have you as a part of our team, but what about the NS Capital opportunity was appealing to you, or what was something that you were happy to be a part of what we were trying to execute for our clients?
Yeah, and it's been a pleasure working with you on this, and I appreciate the opportunity to do it. If you follow kind of the sequence of how the strategy has changed, going to 5 to 7 holdings, and when I'm at 10 to 20 today, it's just another step of concentration, very familiar in how to do that. I'm able to grab what I think are the best opportunities within the 10 to 20 portfolio and populate a more concentrated portfolio for you all. And I think the importance when you have a concentrated strategy that goes after price dislocations is having a client that has capital that matches up your investment horizon. And so I know that the viewpoint of the Alpha Ring is looking out 5 to 7 years in investment horizon. That's a lot of the investments and how we think about what the opportunity is looking at that. And then being one of 7 managers, to me, that specializes in their investment approach, makes it much easier for me to commit capital and focus on the right long-term investments, because I know other folks are focusing on their portion of the portfolio, and I can be laser focused on how do I make the right investments near term, which quarter to quarter, who knows what happens with performance, but longer term, hopefully, is putting it in the right places that are going to generate superior returns for clients. And so it's been exciting for me to be a part of the opportunity.
Well, and we've certainly been grateful for all that you've done for us and for our clients. I think now maybe give our clients a little bit of a specific look at a couple of names in the portfolio. And so, as I mentioned to lead in, you focus kind of on our smaller companies, traditionally US based. I think it would be interesting to have people maybe get one of your initial holdings that you start out with May of 2018, and then we'll kind of then transition to one that's maybe a newer name so they can see what you're looking at today. So how about we start with one of the initial holdings, which has certainly had a very interesting road since May of 2018.
Okay.
Could you talk a little bit about Neighbors Industries?
Sure. So Neighbors is interesting. It's probably the best way to start describing it, similar to financials coming out of 809. The energy sector went through a horrible 2015 through 17 time period, and a cyclical trough that you'd have to go back 50 years to kind of look at something similar. And so right away that attracts us because we know security prices are down. There's less capital that's interested in that area. So there's probably some pretty good price dislocations. Neighbors, I had been familiar with the company in the past and actually invested with them. So I was very familiar, insight as to what they are. For the audience, they're one of the largest global land drillers. So if you're drilling for oil or natural gas, you would use one of their rigs to be able to facilitate that. And so usually what happens in the cycle is you come out and CapEx comes back, you see recovery in capital spending, and folks will reach out to Neighbors and you'll see them start contracting more rigs and getting higher pricing, and that kind of works as a positive to their business model. What changed for Neighbors, which made it even more attractive for us, they were a little bit over levered coming into that 2015, 17 time period. And they changed to become more focused on free cash flow generation, more efficient running the assets, and then delevering the balance sheet. And by delevering the balance sheet, had the opportunity to actually unlock equity value, substantial equity value for shareholders over a long time period. And so we looked at this as a great opportunity. They were a 70% valuation discount because of the leverage to their peers. And yet all their peers combined did not have operations internationally equivalent to what Neighbors was. So to me, it just made no sense, the superior asset base that they had. And so when we look at how the companies, over the last 3 years, when we made this initial investment, we're still invested today because we went through COVID. Everybody knows the price of oil basically collapsed. The space went through another kind of step lower. And it's our viewpoint in that there's been an under amount of investment that's taken place within the energy complex. There's been a lot of focus, and rightfully so, on carbon reduction. But the industry overall, as we go through an economic recovery, we're just going to see more and more supply potential not keeping up with demand because there's been a lack of focus on drilling. And so we think Neighbors is great, well positioned as commodity prices move higher and we see recovery in CapEx for them to deploy. And so they're not going for market share. They're focusing on putting the rigs back to work at higher prices. And then they have a great JV relationship with Saudi Aramco, which no one on Wall Street is talking about. It's not written about because it's going to happen over the next 5 years. But that could actually add about 100 to 200 million of profits as they scale and deliver rigs in that JV. And so it has the ability for the company to get an 800 plus million of EBITDA, free cash flow over 400 million. And the stock today has a market cap that's around 700. So as we further delever the balance sheet, we should believe that's going to accrue more than 1-to-1. And when you look at a normalized profitability and put what the rest of the industry is valued on those normalized profitability, it's a stock price that's at least 5 times higher than we're seeing today. And so, again, we understand it may take a while to go from where we are today as they further delever the balance sheet, but we think you're getting paid to be patient and wait for that one.
Yeah, you see a potential path. One of the things with Neighbors that you've had a lot of communication with the managements of that, and I recall even in January of 2020, before we had the full extent of COVID, that you were impressed with some of the things they were doing then that actually helped them really get through the COVID experience much better than their counterparts.
Yeah. So it's great highlight there, Todd, because it's the debt reduction in the way they were focusing on near-term maturities. So one of the other things that I've learned is the balance sheet risk when you're investing in securities that are underpriced and maybe have a business model that has a little bit of stress. You need to make sure the near-term maturities are to a point in time where it can be handled by, and that's why the focus on free cash flow in my mind is incredibly important. And so Neighbors did a great job in delevering the balance sheet to make sure that their near-term maturity profile was significantly less risky than what it was when you went back 5 years ago. And they were starting to sell off non-core assets and driving a much more efficiency on the working capital side, taking CapEx lower. And so they had that flexibility to be able to weather a downturn. And then they also aggressively, where everybody, it took them a quarter, 2 quarters, they went after their cost structure right off the bat from senior operators who had been in the business 40 years, had been through a very steep downturn in the 80s, and understood it made sense to just take the costs out right away because you're in a cyclical industry, and make sure you're a low-cost provider to be able to manage through that downturn. And so I kind of look at all those things gave us confidence when you had the stock, move significantly lower with the price of oil, to then step in and take a more of a longer term view that they would actually benefit long term from that.
That's right. And for those listening, Dan and I work very closely on the way that he weights the portfolio, and he has been a buyer when we've had these opportunities, and it's resulted in an average lower cost for our shares. But he's been using this management communication and his own research to take advantage of these, and he's done it very, very effectively. So let's move to a newer name in the portfolio. Okay. Let's talk about Gannett. Let the people understand what you see in Gannett.
Right. So Gannett would be one of those transformation situations that we highlighted before. And so everybody's probably familiar historically with Gannett's been around for a lengthy period of time, local newspaper company, which right away everyone's like, why would we ever be interested in a local newspaper company?
Right.
And so we got first exposed to Gannett through a prior investment in New Media. And Gannett and New Media actually merged a couple of years ago. The CEO from New Media, which we knew, became the CEO of the combined entity. Very, very smart operator. And so his vision in combining the two companies was, let's get more efficient at running the newspaper operations. But there was a ton of content that Gannett was actually had within their 4 walls. And I'm going to bring in outside senior folks from other media companies, whether you looked at Disney, Babbel, Spotify, that have success in growing subscription business models. And let's bring them in-house and transition this company to a digital media company. And one of the things that people don't realize is Gannett actually has the 6th largest, and again, for a smaller market cap company, the 6th largest digital audience that's in North America.
Oh, wow.
And so 135 million folks are actually accessing their content every day. And so the goal was we can actually start developing this high reoccurring, very profitable subscriber base and get that up to 10 million over the next 5 years. And so when we looked back at, all right, is there anyone who's had success in the industry of doing that? And we came across New York Times, who actually had gone, and that would be the first one to say, hey, we're following New York Times's roadmap on their success. And what that essentially happens is the market perception changes on the secular headwinds of newspaper, because newspaper has been challenged by the advertising and subscriptions. Advertising are higher margin, and that's been falling and weighing on the whole industry in general. As the subscription growth actually starts to grow, you offset that once you get to a level of the subscription revenue to the business model. And because it's so profitable, it's a natural offset to the advertising. And so then the market can then look through and start to see the potential for the enterprise growing. And so that happened for New York Times at 2 million subscribers. It looks like that's a similar number that makes sense for Gannett. And it looks like they'll be there within the next 12 months. So that initiative has already been growing pretty rapidly. Then the other area, which is incredibly fascinating, is they put together a digital media solutions group that targets and focuses on helping small businesses go out and find new customers, and coming up with digital solutions for them to go out and find new leads. And so in combining their 2 businesses, that's an $18 to $19 billion industry. And Gannett's very fragmented, and Gannett's actually the largest now at 400 million in revenue. And so they're going to look to bring that 15,000 to 100,000 as they grow the sales force and basically sell in more solutions. And that could be a $1 billion opportunity for them from 400 million today. And so when we step back and look at, there's a high likelihood the company can get growth and back to 4 billion, even with the secular challenges in the newspaper business. And then if you look at what New York Times valuation is today, it's north of 4 times revenue. Other digital media solutions, there's a company called Wix, well in excess of 4 times revenue. And Gannett today is at less than 0.3.
Oh, wow.
So we're like, okay, if we get to 4 billion revenue, you start putting a multiple of revenue because all these new businesses are going to at higher margins. So you're going to have free cash flow that's going to be likely normalized higher than 500 million. EBITDA that's going to start to continue to grow. You can start to see, putting a 1, 2, 3 multiple on a revenue basis, 4 billion, a market cap that starts to move towards 10 billion.
Got it.
Versus a billion that we're sitting at today. And so we think, again, it'll take some time as this kind of transformation story plays out, but there's an incredible incentive to continue to kind of accelerate this path. As the CEO actually would get stock as part of his incentive if the stock price is over $10 a share and delivers on the program. He's incentivized, obviously, to continue to kind of move the plan forward. And so we're very excited to spend a lot of time with the company and understanding the opportunity sets. And there's even more things they could do on the content side that we think are interesting.
Oh, wow. Well, it'll be interesting to see how it unfolds.
Yeah.
Well,
and one other thing I'll just highlight is those two names you just mentioned. They're actually, if I look today at the deep value strategy, they'd be in the high 30s from a weighting perspective. And for the NS Capital portfolio, it would be in the 40s. So again, we think two examples of where we have companies that be well north of a double for the next couple of years to hopefully drive some performance long term.
No, that's excellent. Well, thanks a lot for that, Dan. I very, very informative and very helpful. I think let's turn it over to the audience to see if they have any questions for us. Sure. Eric, are there any instructions you need to give to the audience for Q&A?
Sure. There's a along the bottom toolbar of everybody's window, there's a Q&A button. Just go ahead and click that and go ahead and enter your question if you have one, and we'll be sure to get to it. We have a few in the queue already here, Todd. So if you want to go ahead and hit some of those, and as more come in, we can get to those.
We'll do it. Thank you, Eric. All right. Okay, here goes. It looks like first one, Dan. So we have educated, or in a letter, we mentioned in our July letter to our clients about GameStop that we actually did have a position in GameStop, and we mentioned that you were the manager overseeing that. So the question is, tell us about the GameStop experience. So we let them know that you were not just playing the January part of GameStop. You had been a long time investor, but tell us what that was like, kind of going through that January part of GameStop.
Crazy is probably understated, and happy that the market recognized what the company was undertaking. Surprised on how fast and how quick. It's probably the only time I've been investing in a company where the short position went over 100% of the float.
Wow.
Which to me was, again, I didn't even think that was possible. It's obviously the amount of shorting that was taking place in the marketplace. But Todd, I've been invested in GameStop another time historically, because the industry goes through these cycles of new consoles that come, and then the games are high margin that come right behind it.
Okay.
And because of that cyclicality, the time that I've made a lot of money in the past investing is a lot of consumers will go out and buy new games when they know the next game console cycle is coming out. And so you have a pause, revenue drops, and the market gets concerned on how long would that be. And then will GameStop have in these new consoles the ability to have their physical games, which really is their business model. And so that was the genesis of the net investment initially was around playing the cycle that was coming up. And then we had a new management team that actually joined around the same time, two outsiders that came in, CEO and CFO, who had great backgrounds at basically running more efficient operations.
Okay.
And so they came in and said, GameStop, you got SG&A is way too high. Your stores can be consolidated. You have 40 million loyalty members. We can capture those and keep those folks by just shifting and closing a couple stores here and there. Your supply chain needs to be more modernized. We need to spend money there because the working capital is too high. We get take out SKUs and get much more productive on the free cash. And so when we looked at what they had in place and talking through with management, they thought they could get to a higher margin than what the prior cycle had been for the company, which, again, no one on Wall Street had even a buy on the stock. Everybody had a sell. They thought online gaming was going to displace the company. They wouldn't be a beneficiary. Even all the new game consoles were going to still have the ability to play physical games. And then as we went and dug into the asset piece, just to highlight very briefly on that, we were shocked to find they had a 1 million square foot of office space, distribution space that they could do a sale leaseback, delever the balance sheet. They had an airplane. We're not sure why they had a corporate jet. So we figured they could, and they got rid of that. So that was another way to get some incremental cash. And then the last piece, which blew our mind, was they had a magazine subscription called Game Informer. And not a lot of folks know it, but it's got close to 7 million subscribers. And so when we went and looked at transactions, Time Magazine was sold for $80 a subscriber recently. Sports Illustrated changed hands for $40. And even Fortune was over like $100 a subscriber. So there was about 300 million to $1 billion of value if the company needed to realize that for any point in time through the upcoming cycle that could be monetized, and for shareholders that were also attractive. And so we're starting to go through into the cycle, and then COVID hit. And as we know, for all retail companies, we're under significant pressure because the market was concerned that the foot traffic wouldn't be there. You had fixed costs of the stores, and the companies would burn cash. And now GameStop would have the challenge of the cycle coming, and then having challenges of their store fleet. And so we looked at all the assets, and the market cap got down to 200 million in that time period, which looked to us to be insane for a company that could get to 6 billion in revenue over the next couple of years. And we had cash on the balance sheet of 500 million, and they were getting more efficient, just as management was highlighting and running the operation, took a lot of cost out, so the cash burn rate was low in our opinion. And then we obviously noticed that the consumer who couldn't go anywhere during COVID, gaming was an outlet for them. And so all this inventory they had was in hot demand to just get their hands on anything at home, even though it was the old cycle. And so that really kind of worked. And as cash was coming in, management paid down debt and then bought 1/3 of the stock back. And so okay, they're obviously confident of being able to execute. They just retired a tender offer, 37% of the float. And so we were sitting on an investment which was different from kind of what materialized later in the year. But as we went throughout the year, all of a sudden you saw one of the largest shareholders was the founder of Chewy.com, who said this company's making enhancements to the supply chain, but should be an omni-focused company. And his involvement around the same time where you saw an improvement in the revenue and the short position being so high was a perfect storm that kind of led the stock to a valuation level that was much higher than even the peak of prior cycles that we invested. And so that was the kind of the perfect storm that ended the year and to start the beginning of this year. And the last portion of stock that we sold is lower than where the shares are today, but it was up 30x from the lowest addition that we had. So
it was insane to watch that. Now we're grateful for the return we got on that one in your work, because again, you continued to brought our average cost down to very low for our clients, and we took full advantage. Okay, let's move. Next question. Pretty straightforward, but how do you know when to sell? And I would ask that if you wouldn't mind giving us two versions of that. One is, when is it time to just kind of outright sell, like a GameStop or whatever? And when might be a time where you just want to maybe keep it, but reduce the size in the portfolio, so a trim?
Yep. So a hard question for a value person looking at, being early is your biggest risk. Selling too soon is also potential risk.
Right.
So if I look at GameStop as a perfect example, it's when the embedded return of what's being discounted for us that there's a better opportunity to bring in the next name from the 10 to 20 portfolio. And so when you see multiple expansions, especially for companies going through transformations, that's really driving the share price. For me, as a value person on a company that's going through this time period in which you could have a setback, that's makes sense for one, for you to consider to trim the holding. And if you have another opportunity, it's even better that's sitting in the wings to kind of exit. The other thing which would be is if we're wrong about the fundamental value of the company and we
Okay.
come across a data point or an event and that price, the gap to the fundamental value is much less because it's lower than what we initially thought and creates risk, or something on the balance sheet with the assets is less than what we initially thought. And so we hope we don't have, many of those that would make a reason for us to sell. And we've been fortunate to have more of the former.
Right.
And what we found also in this is kind of an experience of running this more concentrated portfolio for NS Capital. And I think the first one actually was our position in Avon that
Yes.
was a takeout in the portfolio, similar to what I experienced back at Brown. But once the position size goes from 25 to 30%, just because if it's a transformation, there could be something that could happen. It makes sense for us, if it's multiple expansion that's driving it, to look at redeploying 5 to 10% of that capital back into something else within the portfolio. That, especially if the company's done really well, the position sizes of something that may be as attractive may have just fallen by the success of another. And so you can kind of reallocate capital. And what I've done is always done portfolio construction bottoms up. And so
Okay.
in thinking that 5-year opportunity for each holding, we know what we think the embedded long-term potential is. And we want to marry up capital with the most amount of capital, like Neighbors and Gannett, where we think is the greatest long-term return. And so the embedded return, when we look out 5 years plus today for the deep value strategies, in the high 300s. For NS Capital, it's in the 400s, because we got a higher weighting on things that companies that we believe could be multi-baggers when we look out on the opportunity set.
Oh, that's excellent. That's excellent. Here we go. Next question. What gets you excited when you find an idea?
So, gosh, I think probably the biggest thing that makes me think, my gosh, we just stumbled across something that's incredible, is when there's a portion of the business that's embedded that the market is overlooking, that is
Okay.
growing in size. And there are public companies valuations today that would suggest that you're basically, the rest of the enterprise is for free, or it's worth multiples of what the market is looking at today. And I'll give you just a real brief kind of description of another one of our holdings, which is Pitney Bowes. In Pitney Bowes, that everybody would know, has been around for 100 years. The mail meter is the genesis of how the business was formed. They had a new CEO that came in from IBM, and he looked at the business and said, we got to find, secular challenges of mail are substantial. We need to find something new that's going to drive the company forward. And so he looked at, they had a cross-border business with eBay that they were handling. And he goes, this is fascinating. We should be able to basically drive a e-commerce and grow an e-commerce business, do some tuck-in acquisitions, and help companies do the delivery, returns, and cross-border fulfillment. And we could really develop something that's sizable. So 8 years later, it's $1.5 billion business in revenue. It's now half of the revenue in total. And so when we looked at that's now scaling up. They brought in folks from Amazon, FedEx, UPS to help get even greater efficiencies to drive the free cash flow of that next couple of years. And then we looked at a transaction, Stamps.com was just bought out at 8 times revenue. That there's similarities for part of the business. And then there's only 3 companies globally that do cross-border. One is a UK company called Global E that just did an IPO. It's at 20 times revenue.
Oh, wow.
And if you look at the cross-border business, it's $500 million. So it tells us that, that $1.5 billion goes to $2 billion for Pitney Bowes over the next 5 years. It should be worth multiples of that. And if you think about the market cap today, it's only $1 billion.
Oh, wow.
So likely you're going to see them either, attract activists at some point. The company will separate it if the valuation overall entity doesn't reflect that. And so that's what gets me kind of, jazzed up when management is growing the right part of the business, doing the right things that creates a lot of value for shareholders, and reallocating along the way that reduces debt, buys back stock that further can unlock value.
Oh, that's fantastic. It looks like we've got another question come in. Value got off to a great start, particularly at the end of last year and early this year. But now, if you kind of go by what you see in the growth value charts, it seems to have backed off a little bit. Have you been affected by any of this potential movement away from value of late?
Yep. So if you look at value in general, there's most of what's in the value universe would be more cyclical in nature today, and smaller market cap companies would be in there. And so when the market has been concerned about the Delta variant and the perceptions on what that could mean to the recovery, you would see some of the cyclical areas in the marketplace have obviously been affected somewhat. And so that has a dampening effect near-term evaluation. So it has affected the portfolio a little bit on that front. And so you can also look at interest rates and longer duration equities, which have actually held up and done quite well and over the last couple of months, which makes sense because the market has been concerned about these near-term time periods. We think, again, as we look forward, that the economy is likely continuing reopening and seeing a recovery that's going to take place that should benefit a lot of our holdings and the more cyclical parts of the marketplace. And even the transformation companies I mentioned, which today I think we believe that there's a combination of transformation and some of the more cyclical names like Neighbors that should continue to do well.
And I know that you have taken some of this opportunity over the last couple of months to add to some weightings. You've repositioned the portfolio, which is what you've done since we've worked together since May of 18, is when you get these opportunities, you take advantage.
Correct. So we recently eliminated a holding that had done well in the portfolio and reallocated that to a couple of our more cyclical names, which had compressed in valuation. So hopefully as we come out of this time period, the portfolio, as I mentioned, the embedded return by those movements increased by about 30% of the portfolio. So we hopefully are kind of getting the portfolio position to be a beneficiary as we move.
Excellent. Well, Dan, it looks like we have no further questions. So I just want to say thank you so much for being a part of this today. We're so grateful for not only your time today, but all your time and attention on our clients' behalves. And we're excited to see where the next 10, 15 years takes us. So thank you so much for being a part of it today.
Great. Thank you. I appreciate the time. Thanks, Dan.
Eric, I'll send it back to you, buddy.
Okay, great. Thank you, Todd. Appreciate it. That was really great. And Dan, thank you for your time as well. And one more final thank you to everybody who joined us on today's webinar. As always, if you have any other questions or follow-up, feel free to contact us. We're always available. And definitely keep an eye out in your emails for our next Meet the Manager, which will be coming out to you in a few more weeks. Everybody have a great rest of your day. Thanks.